Hello, today is the 4th of April, 2012, and let's take a look at the weekly chart. Each one of these candles representing the action from Monday to Friday, going back pretty much almost a couple of years. So we'll start off within the 25, 26 level, and I'm hearing quite a bit about people saying, "Oh, I want to go back down to 25, 26," and what, did you miss it here? And did you miss it here as well? Quite frankly, myself, I would not be waiting for 25 or 26. I personally think that's a poor place to buy when you're at a bearish level, if, of course, the market hits 26. The next significant level is 30. That would be the next level, but breaking below 30, nothing really for support until we hit this next little barrier. But you can say, oh, but we've got support here. This is an area where we twice previously found support since the market had topped, and that's true. And again, the odds are likely that we find some level of support within that area. However, what you'd be doing is buying at a bearish pattern if, of course, the market moves there. It's almost like going short like yesterday morning or the day before, which was a good play, obviously, on the inverted head and shoulders pattern. Sometimes you win, most times you lose. Therefore, a double top is the formation that would come into play if, of course, we make a move down to 26. A double top is just something like that, where you are at a bottom level period like we are here, and you go higher. Doesn't matter where, this is where. And then you retrace back in or around the area of the last low, which was the case, and then back to the area of the last high, which was the case. And if we go back to the area of the last low, then that would create a double top situation. It's a bearish pattern, as a double bottom would be a bullish one. But if we take the length of this pattern, we can draw it down from the neckline, and that brings us, excuse me, a price objective down to, well, 1920. If you do 61.8% of the move, you're looking at about 21, 22, but that's still a long ways away from making it to that level, because we still haven't even had a test of the 30, because that's a significant Fibonacci retracement level from this low and this high. $30 an ounce, right on the nose. If that area is support, then a bullish pattern would come into play if it makes it back to the neckline, because you could say, well, there's a left shoulder, head, right shoulder, and or you could say, well, quite frankly, this doesn't count as a left shoulder because it matched this area here. And that's fine, but then you'd call it an inverted cup and handle formation. Same thing, same bullish pattern, yada, yada, yada. So therefore, with that being said, you're going to have some people that are talking about this being a manipulated market, which I don't see why that's a major issue or not. And I'm saying this for two reasons. Because most people are either on the side of A, they don't care. So if you don't care, then why would that be an issue? And B, because you don't know any differently. And well, that part is just scary. And the reason why I say you don't care is because we still have a manipulated market. If enough people cared about the manipulation, then something would be done about it. But nothing's being done about it, therefore nobody cares. And you can say, oh, there's nothing you can do. Oh, that's false. It's almost like saying, for example, let's just assume your everyday bird, like a starling or a robin or a blue jay or a cardinal, whatever, you name it. If they were pissed off at the human species, what's one of those birds going to do to a human? They'll fly at you, try to attack you. Quite frankly, it'll probably die. One human can beat one bird. But if they got together, 2, 3, 4, 5, 8, 10, 20, 50, 100, 300, 400, 500, etc., it would be just a little bit of a different story. So I'm going to end that analogy there. Overall, again, within this sideways downward sideways consolidation. Sideways because as long as it stays above 26, then it's good to go. But there's no reason why it has to go lower just by using chart analysis. In fact, it can do multiple different things for the Fibonacci retracement to play pretty much as perfect as it's playing in here. For example, let's just go back to in here. If instead of this big red candle, if it would have bursted higher up to say, well, I don't know, 39? Yeah, and then maybe come back down, stabilize, do something like this, and then boom, quite frankly, Fibonacci would still be playing perfect because 39 would have been and still is that next expected level, moving or breaking above where we are now. Why is the reason for that? Because of the 2/3 retracement from this low and this high. And then you come back, find support at significant level, play around with this level, stabilize, and boom, you break higher. That's normal. That would be another way for it to come into play. So there's multiple different ways, and to say that a market has to go just one direction from where you're seeing it, well, that's wrong. Also, when you see a setup occur for whatever, the market to go higher or lower, and it doesn't, then that can be considered that of a failed move, which can oftentimes bring a fast move in the opposite direction. Well, we barely did break the neckline for this head and shoulders pattern. Therefore, is that going to create that fast move? And is 30 big enough or low enough for that fast move, considering the inverted head and shoulders pattern was really not too big to begin with anyway? Finally, if you look at the size of the moves, just going back from this bottom at the end of 2011, in the chess game of your turn, my turn kind of deal, or whatever game you want to refer to, if you look at the movements in here, the size of these up candles compared to the size of the down candles, it's not really that much of a contest. The bulls would still be in control of the market, but what's the velocity going to do? And I don't mean velocity like it's like the word's defined as, but velocity as in time. So maybe I should use a different word. If you say take how many candles was this? Like eight candles up and say 16 down, then normally that would be a positive thing for the bears, which sort of was the case here. You had a situation where the market went up for about 75% of a year, and now it's done this for about 94% of a year. So it's had a longer time frame going down, but it still, of course, hasn't broken into a bearish mode by holding the level that must hold for this move to not fail. Therefore, that's another reason why I would not be surprised, even in a manipulated market, why either A, it would hold at 30, or maybe it would have a failed double bottom, and then people who are right to buy at 26 would obviously be that, right? And then the holding of the big move would occur. Or, of course, what I and other people have been talking about as far as this level, which would most likely be a fast move in here, a physical disconnect on the real exchange, however it would play out, and then like most bottoms, you would have snapback rallies and then just work its way like it normally is supposed to work out from that point forward. And that's why if you're looking for the trend to change, it's still got to get above this line in here, and it's got to break above the 39. So it's two things above this trend line and above the 2/3 retracement from this high and this low for there to be within this manipulated market that people must enjoy to have confirmation that we're going to continue to the upside. Thank you for tuning in. Bye-bye.